This is Larry Williams on June 6, 2022. This is a special presentation we're doing for all of the people on our email list. I've been doing a lot of stuff for Jim Cramer, StockCharts.com, and the other day Louise said, well, Larry, why don't you do something for just our people? Something where maybe we can go into more depth as well. So that's what we're doing today with this presentation. The purpose is to really go into a lot more depth than I can, and Cramer can just take a little bit of my stuff for just a few moments, really. And StockCharts.com, I'm kind of limited to what I can talk about there as well. So we really want to get into some depth today. I'm going to be first talking about stocks, and then we're going to be talking about commodities. And I've got a lot of things to show you I think you'll enjoy, and some forecasts coming up as well. First, the stock market. Is it a stock market or a market of stocks? As Jim Cramer says, and I think it's been said before, there's always a bull market someplace. Even this year, there have been a group of stocks that have been real strong. So you really need to focus on groups, not just the overall stock market, unless simply buy and hold on. Okay, so there's a lot of groups in the marketplace we can talk about. They're momentum stocks right now. I guess we'd call those the F.A.N.G, the Facebook, Apple, Netflix, Google, stocks of that genre. There are growth stocks. Value stocks, special situations, these are things that kind of come and go. There's sectors like the energy sector this year was so strong. And there's dividend investing. I'm going to talk all about all of these groups briefly in this presentation today. And blue chips. When I got involved in the market in 1962, the Dow Jones Industrial Average represented what I would call blue chips. But I don't know what happened to blue chips. We really don't have blue chips as such. What the Dow is now is a lot of hot momentum stock, growth stocks, and some value stocks. This idea of blue chips is kind of lost when you look at the averages, but I'm going to show you something today that I think maybe we could put into that type of a category. The problem with momentum stocks, looking at Facebook now, is, boy, they can get hit and whacked really bad. If you bought Facebook here, you weren't ahead of the game until over here, and now you're behind in the game. So it's a tradable stock. The momentum stocks, I think, are tradable stocks. We have tools you can trade it with. This is our money flow index. Buying here, buying came in here, buying here, buying here. Oh, selling up here. Those are selling areas, right? And buying has come into Facebook recently. So these wild, hot, popular, most active stocks, I think you should look at those as stocks you want to trade, not just simply buy and hold on to. Here's the thing I just love to talk about. Growth does not outperform value stocks. We've been teaching that in my stock course for, 10, 15 years now. And this year shows it perfectly why. Look at the growth stocks this year. The S&P 500 growth index is down 20%. Small cap growth down 16%. 400 mid cap growth index down 15%. The value stocks, though, didn't get down 2.6%. Value index down 4.5%. What a difference, between value and growth. And that's why value outperforms growth. Because now, for small cap, for growth index to get back, it's lost 20%. It's got to get back, 40% to get back to where it was. Whereas these don't have to go back as much to turn profits for people who are holding them. Here's the rubs. What happens when you have a bear market? The growth stocks get killed. That's real hard for them to come back to where they were as quickly because they get hurt. Now, they may go up more in a bull market, but we have up-down markets and down markets and up markets and down markets. And when those down markets come, these get ripped so much that on a long-term basis, value prevails. When I'm out publicly and people say, well, I have these great growth stocks, I say, well, how about value stocks? And people, oh, I don't want those. Value, that's kind of boring. That's old man. No. Value stocks outperform growth stocks. Big lesson for you to learn today. On a long-term basis, value trumps growth. Momentum stocks, the hot stocks that the public's in, they're for trading. Big rallies get out of them. Big breaks buy them. Remember Flip Wilson? He was great. When you're hot, you're hot. When you're not, you're not. Well, that's what sector investing is. The hot sector this year has been energy. It's probably about ready to end. But these are sector markets also, or markets that you need to time. Be very careful because they don't go forever. They get hot for a while and they get cold for a while. And here's the one that really I think is way overlooked by the vast majority of investors. These are not really tradable stocks as such, but look at the rate of return. The dividend on these stocks, annually mortgage 13.2%. The company's $10.1 billion. BIGZ, a $2 billion company, 13.4% return. A $1.8 billion company, 12.6% return. $6 billion company, 12.5% return. $358 million company, 12.3%. There's a lot of money to be made in clipping coupons for no work. I think this is an area that people think is highly risky to be in these stocks that pay this high a dividend. Now, the reason they do is these are primarily REITs, and by law they must dividend out 90% of their earnings, and they have some special tax accommodations for them as well. We've been in these stocks for a long time, and they go up and they go down. So the ideal strategy, when they're down really bad, buy them. And then if they do increase their dividend, I don't know if these will increase their dividend, but if they do, your return's going to skyrocket from where you bought them, as long as their dividends stay stable. Most of these have been pretty stable in their dividends, so clearly, scenario of investing most people don't look at, and most should. I like stable stocks. These are, I guess we call them blue chips in a way, in that they are stable. I think a stable stock is more important than blue chip or any other term we put on. And these are companies we buy stuff from every day. Altria, we have to buy the stuff they make. Procter & Gamble, you're buying the razor blades and soap and whatever. Pepsi-Cola, you're going to their snack food stores, you're buying Pepsi-Cola. People buy this stuff virtually every single day. MDLZ, this is a snack company. Kraft Heinz, well, cheese and ketchup and all this stuff. That's crackers. General Mills, Diageo, a big alcohol company. Colgate-Palmolive, toothpaste, soap, whatever. Right? This is stuff that the demand doesn't go away for this suddenly. People need this, so it's a more stable environment. The only problem these companies have is, can they manage their profit and loss statement? Because they have demand. The demand is naturally there. The demand doesn't just go away like suddenly Facebook demand went away. That doesn't happen. The demand is pretty much consistent on a long-term basis, so it's just up to the management of the company to have products they can profit with. And then where we buy these things, Walmart, Costco, these have been great stocks. Target, Amazon, except for it got a most active stock, a high flyer stock. Now that it's being cut in half with the split, that might make it a little more publicly traded, not quite as hot of a stock. Home Depot, Lowe's, these companies have knocked it out of the park, as have long-term investors. So I really like the idea of consumers have to buy stuff, and they have to buy stuff from places. And I think these are a lot more stable than all the pipe dreams and hot stocks that come along. They may well outperform these markets, but when they crash, they may not come back, and they crash bigger and more often than the stable stocks. This is from 2019. Impending recession. What can I do? Oh my gosh. Recession 2019. 2020. Oh, a recession. And here it is, 2022, a recession. Every year, somebody is saying, we're going to have a recession. There's so many Cassandras out there in this business, and they're really playing on your fear. We're all fearful. We don't know the future for sure. And they talk about all these reasons we should have a recession. Primarily, it's a political discussion. It has nothing to do with reality. So today I want to talk to you about reality. Here's a great index you can use from the Chicago Federal Reserve. It's a CFNA diffusion index. I'm going to show you a chart of it in a moment, but you can Google it yourself. You can follow this as well. It's really pretty simple to understand it. Let me show it to you. Here is their index, diffusion index, going back to 1960. Now, the gray line you see, that's when we've had recessions. Notice that as the index starts to get close to zero, we start to get into recessions. Oh, here we didn't get into recession, so it's not perfect. Not much is. 1990 we didn't. Oh, there we go. We got into recessions again. Also notice when it's very high, it takes a long time before we get into a recession, doesn't it? We're really high up here. It took a couple of years before we got 5 years before we got into recession. So very high readings tell us we're not immediately facing recession. But if it does start to peel down, as it did here, we better be very careful. So you would say here the index was very high. We didn't have to be ready for recession yet. But you get the idea, right? And here's updating. This is 2000. Oh, it started to fall apart. Recession came. Starts to get below zero. Recession comes. Got below zero here. Didn't get a recession. So we can say it doesn't always cause a recession, but every recession has occurred when it's been below zero. And look where we are now. We are way up here at very high levels. Well, there will be a recession in the future. I can't tell you exactly when, but the indicators will tell us when these start to pull over and roll to the downside and get close to zero or below zero. Yeah, we're going to have a recession. Are we there now? No, we're not there now. So I think we're going to continue to see a pretty decent economy in the market. We had dinner with a friend last night. Retail business guy said he can't believe how busy he is. He can't get good employees. He can't find workers. Every place I go, there's help wanted signs. I want to go into business, a great business of printing help wanted signs. That looks like the best business right now. So as long as we see that people are working, I don't think there's going to be a recession. One of the very best leading indicators of recession is unemployment. We continue adding new jobs to this economy. Unemployment numbers are flat. They have not increased. If they start to increase a lot, yeah, that's really negative. We have to watch out for that. But as long as people are working, the economy is booming. And that means there is no recession in sight. The Cassandras will again be proven wrong. I'd like to take a look now at the Federal Reserve. They were formed in 1913. President Wilson signed the Federal Reserve Act of 1913. By 1914, they had set up shop and they were busy. I have said now for I don't know how many years, I think they didn't get their act together until 1950. It took them about that long to figure out how to do what they did, how to understand monetary conditions and what worked and what didn't work. I'm certain it's still a learning process for them. But I think I've always thought that 1950 was a significant change in the marketplace. And this week I saw this chart from Ned Davis Research. This is really interesting chart. This is how much markets declined in bear markets, and down here how long it took. Now this is pre-1950. Look at all the pre-1950. They took a lot of time and they came down a lot. 1914, 11, 21, 1907, 1932, 1903, 1942, all prior to 1950. Now, wow, that kind of supports my thesis that the Federal Reserve, something changed around 1950. Fundamental change in money supply and the Fed holding the economy back or helping it when they needed to. Actually, we could take out over here 1933, 1917, 1938, 1929. They show the 1929 that's that first down move that continued until 1930. So a lot of these numbers over here could also be over here. We see that recently the time of bear markets has been very limited and the extent has been very limited, usually maybe 25%. That's been the limit of it. Look at all that. If we draw a line at 25%, that's where most of them have been. So that's pretty interesting that there has been a significant change, and I think it is because of these guys. I know there's a lot of people saying, oh, we should abolish the Fed, they're a clandestine group, whatever, but I know this, we haven't had long-lasting bear markets since they really got involved. So I think there's way too much chatter about them being some evil, monopolistic, whatever they are, but the reality is they've done a really good job of handling the economy. The economy's always going to have ups and downs in it, and I expect that we're going to have a straight-up economy forever. They've moderated the declines, especially since 1950. Okay, earlier this year, actually at the end of last year, 2021, this was my projection for inflation. The black line is the CPI index, and my inflation index forecasts that we should start to come down this year and probably continue deflating until 2026 or see a lesser rate of inflation. Well, the CPI index finally turned down. The last reporting period, it was down. That doesn't mean we've topped out for sure. We may go right back up, but probably won't. There's been a pretty good about 6-year cycle in this market. So I think we're going to start to see less inflation pressures. So the bugaboo, the fear of inflation, is going to be not as rampant in the stock market, and that wall of worry of inflation is going to go away. It'll still be there a little bit. The Cassandras will still bring it out and talk about it. We're not going to immediately come down, but we're starting to lessen inflation, and I think there's some good reasons why. Here's what may be one of the causes of inflation. The gold line is inflation, the CPI index, and the black line is money stock, but pushed forward 9 months. So as money stock starts to increase, inflation increases. It goes down, inflation comes down. It increases, inflation increases. The money stock goes up, we start to inflate. Comes down, we start to deflate. Comes down, comes up. And look at that, this huge inflationary spiral that we've been in. Well, look at money stock. And look at money stock now. It has come down, which is one reason I think that we can expect inflation pressures on the stock market. The fear of inflation will be mitigated in the future. And there are more reasons too. Here's an ETF representing wood, the timber industry. And we had a huge inflationary run up. Remember how, we can't build houses because wood is so expensive. Well, since 2021, look what happened. It's gone essentially flat. It hasn't gone anyplace. And lumber, which has been really a big driver of CPI index, look what it's done since 2022, the first of this year. It's actually been in a bear market. So I think there is growing evidence. You look at the grains, they look kind of like this, had a big run-up move. They haven't gone any place now. The only one that continues going up is the energy market. So once the energy market peaks out, which will probably be September of this year or something like that, we'll look at that in a moment. I think then we're going to really see a lessening of inflation. So that's my ideas of what may happen for inflation. Now, something really interesting happened. This is from a friend of mine, Mark Ungerreiter, did a really interesting chart. The lines that you see and the dots are when we've had 3 consecutive or 4 sequential days in the past 6 days, 4 out of the last 6 days, where the New York Stock Exchange upside volume was 80% of all the volume was on the upside. So 80% of the buying was on the upside, and 3 consecutive days are the red dots. And look what's followed this huge influx of buying. A little early, but not that far from the bottom. And we just had them again. So this is pretty staggering. Marty Zweig first turned onto this idea, and maybe it was also done by Lowry Reports many, many years ago, but we've seen extreme strength. More than 80% of the New York Stock Exchange volume, or more than 90% of the stocks advanced for the day. It's been a really good measure of stock market lows in the marketplace, and that just happened. Well, that were big moves. Could we be facing a big move like that now? Unheard of. Who would even think about that? But I'll get back to that in a moment. A very brief look at future markets. I think gold is set up to rally, bonds to rally. Stock indexes, I think we could be starting a 3.5-year bull market. Crude oil, a rally, and then I think it's going to peak out. Okay, that's the summation. Let's look at some charts. Here's gold on a very long-term cycle. Should have come down, but starting about a month from now, the cycle starts to turn back to the upside. So I think we're in the area when we can expect an increase in gold. Interesting, this year when we inflated, gold didn't go up. Typically, gold's supposed to go up when we inflate. Well, it didn't. Gold is driven so much by supply and demand, and some cycles can be really helpful, and it suggests now that we're going to start to see this cycle turn up to the upside, and finally the gold bugs will be happy and be rewarded. Crude oil, here's a long-term cycle of crude oil. You can see it pretty well followed the cycle. It suggests around another couple, 3 months from now, we start to come down as we did over here. We should get into this part of the cycle. So I don't know that we're there yet, but we do have a downdraft scheduled for the last 3 or 4 months of 2022. This a little shorter term basis also suggests right now we come up, rally, and then see that decline start in October time frame. So hopefully that'll give you a view of the future. Now here's an inside look at the stock exchange. This is really interesting. The black line is the advanced decline line, which has nothing to do with the Dow Jones average or the S&P 500. This is the net number of stocks advancing and declining each day, the cumulative sum of advancing and declining stocks. And they're pretty clear cycles to it. And we're at a cyclical low. That suggests we can rally up, have a pullback in July, have a rally up into August, pull back into September, and then take off to the upside. So this is the type of stuff I don't get to get into very much in the TV shows and the YouTube stuff, but we can look at the internals of the market to get an idea of the cycles, the underlying cycles, and here it is for the advanced decline line. So now you have another little roadmap, a path here that we can follow for the stock market. Now, the advanced decline line, my longer term work, I noticed that it has big surges to the upside about every 3 years. This was 2005, come to late 2008, and look at the cycle comes up again, right? And we have a nice up move. This one peters out, this one continues going. But this little cycle in the advanced decline line, we lose the energy up here, mark come down, takes off again. This 2006. Now we come forward, here's that cycle again, July 2012, nice up move in the market. Notice that they have these moves. We see the same repetitive move over here, and look what happens, another nice up move in the market. About every 3 years, the advanced decline line does that. Okay? So now it's time to go out on a limb. I'm going to do that right here, right now, for you. Here's the advanced decline line. These short-term surges have been 70% correct and forecasting large moves in the market. There was 2018. Here was 2020, and we've just started one. I think we're in a very bullish phase in the market now. Not using stock indexes here now. Remember that. We're looking at advanced decline line and when surges of buying comes in the market, and we're right here, right now, at the time we can expect a surge in this market in the advanced decline line, which would be very bullish for stocks itself. Okay, another interesting thing right now is I've always said high levels of open interest usually mean we're close to a market high. Low levels we're at a market low. Very basic idea. Here is the small contract, the future contract for the Dow Jones Industrial Average. Look at high levels of open interest, market tops. Relatively high levels over the last year or so, market peak. High levels of open interest, market peak. High levels of open interest, 2007, and market peak. Low levels of open interest, low levels of open interest, buying opportunities. And recently we've been at a relatively low level of open interest. I know it's a little subjective, but it's an interesting idea that, yeah, we're in the area where we expect market rallies because the public's out of this thing. Open interest is down, but there's more. Hold on to your hats, ladies and gentlemen, guys and gals, because we not only have open interest, we can also look at the commitment of trader report for the Dow Jones Industrial Contract. I noticed in the past when we had a huge increase that the red line are commercials and open interest was coming down, there we were, right? We have open interest coming down and a big increase. The red line commercials are doing a lot of buying. Aha, market bottom. And this is where we are now. We've seen that reduction in open interest and consistent accumulation by the commercials. In fact, this is the highest level of their buying since back here. And high levels of buying have been associated in this futures contract with rallies in the marketplace. Notice the green line, that's the small speculators. They didn't want to buy down here. They were buying up here. Oh, too early. They tend to do the wrong thing. At the recent market highs we saw up here, they're big buyers. They've been getting out, no interest in the market. While the commercials have been interested in the market, that is really bullish. And just a moment ago, I showed you when we have the 80 or 90% upside volume in the market occurring, that's really bullish too. So I think we may be at the start of a 3-year bull market. I'm going to take you back to 1902 now. This is a cycle in the market that I found that wasn't very good back here, really. The market should have had a low here. It didn't, but it then got in phase with the cycle. Really got in phase. Okay, let's come forward in time. Next time was 1922. And sure enough, we get the 1, 2, 3 year up move in the marketplace. We come into 1942, and again, what do we get? Wow, nice 3-year up move in the marketplace. We come into 1962, all the way up to the 1966 peak. That's the cycle operating in the market. Here it is in 1982. We run up, go sideways, and start to get really strong again. This doesn't say buy today or buy till tomorrow. What it's telling us is the momentum, the cyclical pressures are to the upside when we see this cycle. In 2002, there it is again. Momentum's to the upside. You want to be a buyer. You want to hold on to stocks. You can buy big dips in the market. You can sell really big rallies in the market, but we should expect the trend to the upside. And this is where we are right here, right now. In a couple of months, this 3-year cycle kicks off to the upside again. So that, coupled with what we just saw in the Dow Jones future contract commercial buying, what we saw with the 80-90% upside volume coming to the market, I think I'm going way out on a limb here and say we could be starting a heck of a bull market just about right here and right now. Okay, let's talk a little bit about individual stocks, a couple that I'd like to go over with you. We're looking at Apple right now. Here, the blue line is a seasonal in Apple, right in the area of a low coming up the middle of this month, and a cycle low. So you might want to look for some buying opportunities. No, this is the seasonal pattern back here. Nice rally in the market. And then again, around the 1st of October, we've seen nice rallies, seasonally speaking, in the market, right? And in phase with this up move. So you have 2 opportunities coming in Apple around the middle of June and around the end of September. Costco, this intrigues me. I love to shop at Costco. You can drop me off and let me walk around in there all day long. I just like to look at stuff. So the long-term cycle of Costco, which turned down December last year, is now starting to move to the upside. And the seasonal is also to the upside. It looks like we could get a nice sweet spot here where we get not only the longer-term cycle, but the seasonal pattern moving to the upside somewhere in August. Now we can focus in on that a little bit more. This is the pattern that it should follow. Notice I don't know, it didn't say it will, but it should. So if Costco starts to run up and around the middle of June starts to dip, it will be following this pattern. Or if it just holds flat, comes up here and holds flat, then look for around the end of June for this market to take off again. So June 23rd, somewhere in that period to the middle of July, it should start a nice up move in the market. So you can look at this as a seasonal sweet spot, cyclical sweet spot. It's been following this pattern pretty well. So it should dip a little bit or hold flat in here, but right around the 23rd, it should start to move to the upside again. Well, that's going to do it for this presentation. We've got about half an hour. I hope you've learned something. Oh, there's no links, there's no upsells. This is something we decided to do. We do have a lot of friends on our email list. Some of these, I mean, my gosh, we go back 20, 30 years with some people on our email list. It's like a family of people. So I do enjoy doing this, obviously. And I've learned every time I do these things, I learn a little bit. I hope you've learned something to do today as well about the marketplace. I hope this has been a good experience for you. You've enjoyed it. And until next time, this is Larry Williams wishing you good luck and good trading.